So continuing on in AUC Section 240 and our considerations of fraud as it relates to the financial statement audit, we're going to take a look at now how we should evaluate the fraud risk factors. So in the prior videos, we had discussions with management, we had discussions with those charged with governance, and so now we want to evaluate some other information to maybe corroborate what management and those charged with governance said, but also to understand deeper where there might be some misstatements due to fraud. So this is in AUC Section 240.22 through 24. And the first requirement here is related to unusual or unexpected relationships that we may identify. And that might come through our analytical procedures that we perform as part of our risk assessment. And that's in AUC Section 315 that describes these analytical procedures that we're supposed to perform. But basically, we'll look at the relationships between various accounts and changes from prior years and such to understand what has happened in the accounts from prior years to current, and also the relationships to identify things that are sort of unusual. And so we should use that analysis that we perform in AUC Section 315 to try to identify risk and material misstatement due to fraud as well. And since revenue is one of our biggest risks for material misstatement due to fraud, they specify here that our procedures need to relate to revenue accounts specifically. And so also there may be other information that we obtain throughout the audit or throughout the risk assessment process, and we should evaluate that on and consider whether that information indicates risk and material misstatement due to fraud. And so they specify here in this 240.24 that fraud risk factors may not necessarily indicate the existence of fraud, but they have been present in circumstances in which fraud have occurred, and for that reason, they might indicate a risk of material misstatement due to fraud. So we need to evaluate all of these risk factors that might prove to be actual fraud. So we have a lot of different explanatory material sections here. So let's go down to those sections. It looks like 24 through 32, and then 46. Okay, so now we're down in the explanatory material for this particular section that we're trying to understand relating to evaluating fraud risk factors. And first we'll discuss the unusual or unexpected relationships identified, and that's through the analytical procedures that are required as part of AUC Section 315. And so it explains a little bit here of what the analytical procedures entail and what we might be looking for. So the analytical procedures include data analysis techniques ranging from high-level review of data patterns, relationships, and trends to highly sophisticated computer-assisted investigation of detailed transactions using electronic tools such as data mining, business intelligence, and file query tools. And also the degree of reliance that we can place on those techniques is a function of the source, whether financial or non-financial, the completeness and reliability of the data, and the level of disaggregation and nature of the analysis. So we can see this analytical procedures can get very complex if we're really diving into the data, what could be financial or non-financial related information. So if, for instance, the revenue piece compared to the number of widgets sold, so we have a financial and non-financial piece, and if there's something odd between those two, we might have a risk for fraud that we should look into. So here they explain a little deeper into different analytical procedures that we could do relating to revenue that might indicate a material misstatement due to fraudulent financial reporting. So as that example we just discussed, comparison of sales volume as determined from recorded revenue amounts with production capacity. So if their reports say that they sold more items than they could possibly produce, so they're over capacity, that might indicate recording fictitious sales. Also, we might look at revenues by month. That way we can see the revenues at the end and the beginning of the end of the current reporting period and the beginning of the next reporting period to see if maybe there was a higher amount of returns after year end, which would signal that maybe there's an existence of side agreements where the customers return the goods after year end to make it look like we had some sales in the current year when actually it was they were just planning to return them afterwards, so then we shouldn't record revenue in that case. Here's another example. We might also look at the trend of sales by month compared with the units shipped, and that would tell us if there's a mismatch between those two, and maybe there's a material misstatement of recorded revenues. So we point out here that analytical procedures that are very broad or very high level might not be very helpful in honing in to specific fraud risk. They are helpful in the planning process to give us a broad initial indication about whether material misstatement of financial statements may exist, but in order to hone into the fraud risk, we might need to disaggregate that data a little bit further. For instance, what was suggested above by looking at data by month rather than just looking at the revenue by year. And that would be helpful in seeing different trends and spotting unusual circumstances. So typically what might happen in an audit is in our initial planning stages, maybe under AUC Section 315, we would look at accounts at a high level, broad basis. And then when we're actually digging into the revenue, when we get into the testing, we might disaggregate it into the different products and by month and other disaggregation techniques and able to hone into a better analytical procedure. So moving on, as we saw in the requirements above, there's other information that could be helpful for us in identifying risk of material misstatement due to fraud. For example, the discussion among the engagement team members that we saw in a prior video might be helpful. Also, from our client acceptance and retention processes, which are in AUC Section 210, and also experience gained from other engagements that we perform for the entity. For instance, if we review their financial information or interim financial information, or maybe we also do their tax return or something like that. So we could use the information that we know from there to understand the risk of material misstatement due to fraud. And finally, evaluation of fraud risk factors. So what's really difficult about identifying fraud is it is typically concealed purposefully, and we typically don't have access to all information within the company, and there may be things that the company withholds from us, and that's part of one of the inherent limitations to performing an audit, as we discussed in AUC Section 200. Nevertheless, we might identify events or conditions that indicate the fraud triangle, for instance, an incentive, an opportunity, and a rationalization. For example, if the entity needs to meet certain expectations of third parties in order to get financing, that might be a pressure to commit fraud. Also, maybe the bonus structure in place is somewhat unachievable, and so in order to achieve a bonus, employees might commit fraud. Also, if we notice the control environment is not very effective, then that might be an opportunity to commit fraud. And as we've seen in other AUC sections, part of being an auditor requires us to exercise a high degree of professional judgment, and that goes for fraud as well, because the determination of whether a fraud risk factor is present and whether it is to be considered in assessing the risk of material misstatement of the financial statements due to fraud is very subjective, and so we need to use our professional judgment to understand what's important and what's not. And so we've got here some fraud risk factors related to fraudulent financial reporting, misappropriation of assets in Appendix A, and we'll jump down to that section here in a little bit once we get down and finish out these explanatory material. But those fraud risk factors are sorted and categorized and determined from the fraud triangle. For instance, they'll provide us some examples of incentives to commit fraud, or opportunities to commit fraud, or rationalizations to commit fraud. So they emphasize here that the list in Appendix A is not every fraud risk factor, and there may be other fraud risk factors that exist. And on the other side of the coin, if one or more of the conditions does not exist, then that doesn't necessarily mean that there's no risk of material misstatement due to fraud. So we need to, of course, as we saw in prior videos, we need to be professionally skeptical throughout our engagement. And finally, of course, the relevant fraud risk factors depend a lot on the size, complexity, and ownership characteristics of the entity. For example, in a large entity, there will be a lot of structures in place to prevent fraud, and that might be the oversight of those structures of governance, an effective internal audit function, and the existence and enforcement of a written code of conduct. But however, in a small or less complex entity, these structures may not be in place, but there might be other risk mitigating factors about the entity that supplant these. For instance, there may not be a written code of conduct, but the company may have developed a culture that emphasizes the importance of integrity and ethical behavior through oral communication and by management example. So maybe not formally written down, but there is a tone at the top emphasized here. We also emphasize here the domination by management, or of management by a single individual. So if we have a single owner operator of a company, that could be a good or a bad thing related to the risk of fraud within the entity. So the good might be that this owner typically may authorize all the transactions or important financial and operational aspects of the company. And so in that case, it's effective internal control over reducing the risk of employee fraud. However, the same owner-manager could possibly override controls, which would present potential deficiency in internal control. So as we stated above, a lot of this depends on our professional judgment. And as we saw in prior AUC sections, as well as this one, we're not out to find fraud. We're out to understand our risk of material misstatement due to fraud by performing all of these procedures.